Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Feroz Aziz, Deputy CEO on Lati Private Wealth Management. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 8657974571. You can email us your query on themoneyshow@etnow.tv. Hi, good evening, Feroz, and welcome to The Money Show. We will start with the first query, which is from Ansar. And Ansar says that he has two funds in his portfolio, Mirasit Focused Fund and Invesco India Focused Fund. He is doing an SIP in both of these funds. And he can add one more fund for the SIP of 5,000. And he wants to understand if this amount is enough or is there any kind of adjustment that's needed. I mean, to advise him in detail, we would need to have him on the phone line, which we don't, clearly. But then talking about the SIP amount of 15,000 that he wants to do out of these two funds, any changes over there, Feroz?
Yeah, a lot of them, Kavita. Like in the pretext you said, there are several funds. There are about 380 active funds in the industry. Choosing those 3, 4, 5 could be tricky. Now, for example, in Ansar's case, the two funds which he has bought, both are focused funds. The precise one-year return is -2 and -0.5 for both these funds. But the worst schemes we would have recommended in our shows would be at 8%. So the point I'm trying to make is scheme selection is a very, very integral part of generating returns. You can be married to an asset class, but you can't be married to a scheme, especially not a category. In Ansar's case, he's only focused on one category, which is focused fund, ironically. So every scheme has a different return, diverse return. Now, the best one in our 11 scheme has generated 19%. The worst one has generated 17%, and both these schemes are in negative. So the point is, choose schemes wisely, take unbiased advice from the Money Show, and buy schemes which can actually help you meet your objectives. All of them are called equity schemes, but their performances are so diverse that it's startling. And if you look at the data, it'll mind-boggle most of them. So let me tell him to exit both of these. But I think the one which goes on the anvil, the first one is an Invesco India Focus 20. I can give him some other schemes, 6 of them, which from our perspective, given the next financial year is just approaching, would be more contemporary and would have a better future, a relatively better future. So SBI Large and Mid Cap, Quant Active, HDFC Small Cap, HDFC Flexi Cap, Kotak Emerging Equities, DSP Small Cap, and SBI Contra. These 7 schemes. If you've got 15,000 rupees to invest, you can afford to have 7, 8 schemes, which brings down the risk of a specific fund manager or a category, because all the schemes which I read out are from different categories. And then if you left Mirai asset focused fund in your portfolio, that leaves you with almost 7, 8 categories in your portfolio. So that's what I would do if this were my money answer.
Just one more question before I move to our other caller who's online with us. Feroz, the redeeming strategy is also very important. Now, if you've suggested an exit from a particular fund, should one just stop investing or just redeem all the amount now and then start investing in the funds that you recommended?
I think by just moving the subsequent installments is not so meaningful. So whatever money you have accumulated, that could in turn be a larger portion. If you're doing an SIP for 4 years, then you have 48 installments already inside, and that's your money too. So you have to care for that more so than the subsequent installments. So to answer your pointed question, Kavita, all of it needs to move if you're very sure about it. If exit loads are still applicable on certain number of units, because the exit load is applicable to each unit having finished 1 year. So you're not going to get your money out easily without getting the cost impact. But you have to take more care of the accumulated money and move to the subsequent schemes which you believe can do better for you. Now, in the Invesco space, Tahir Basha, who's the CIO, I personally think if you have to stick to that asset management company, an Invesco small cap would be a better idea. Small scheme, 1,400 crore, 1,500 crore. But in the small cap category, I think Tahir managing it personally would have that little fillip in terms of outperforming their corresponding benchmarks.
Sure. All right, we move on to our next viewer who is on the line with us, Somalia Majumdar. Somalia, hi. How are you doing? Good evening.
Hi. Good evening, madam. This is Somalia Majumdar from Kolkata speaking.
Sure, sir. You want to start an SIP of 20,000 for 25 years?
Yes, madam.
So far, you are not investing anywhere?
Right now, I'm doing SIP only in Parakparik Flexi Cap Fund.
Okay, only in Parag Parekh Flexi Cap.
Yeah.
And what is that amount?
5,000 rupees.
All right. So apart from that, this 25,000 you need to invest, right?
20,000, yes.
Um, and tell me something. For 25 years, what is the corpus?
Yes. Retirement planning.
Okay. Yeah, but then what's the amount that you want to accumulate? Any target?
Target 3 crores.
All right. Feroz, 3 crores and 25,000 SIP, including Parag Parekh Flexi Cap.
Yes, I think Mr. Mazumdar can very easily accumulate 3 crores if history has something to tell us about what's in store. About 14% per annum return is not something which is unfair for periods like these. If you're very selective about your schemes and you're able to put in that energy to manage your asset class in terms of scheme selection as well, so you can almost get to about 5.4 crores. That's the power of compounding, which most human minds and like yours and mine can't comprehend. So 5.4 kind of crore corpus can be accumulated at 14% returns. Now, when you come to your one scheme, 5,000 rupees, when the minimum amounts are as low as 500 rupees, it does not make prudence to have one scheme in the portfolio ever. Now, Parag Parekh FlexiCap has a certain strategy. Of course, there are global stocks in that portfolio. There is reasonable diversification, but the diversification can't just be at stock level. It has to be at AMC level, at category level, and the amounts merit more schemes. Even if some other viewer is listening and he's got about 3,000-4,000 rupees, don't go by one scheme, go by multiple schemes. Brings down your risk considerably, especially when you're speaking of Parag Parekh. Its performance over the last 1.5 years has been quite a disappointment given to the global crisis and the outperformance of India relative to the rest of the world. Now coming to the schemes, I would want to reiterate the same schemes like we did with Ansar. SBI Contra, SBI Large and Mid Cap, DSP Small Cap, Kotak Emerging, Invesco India Multi Cap, HDFC Focus 30 and HDFC Flexi Cap. These are about 7 schemes in the portfolio. HDFC Flexi Cap and HDFC Focus 30 are managed by Roshi Jain. Of course, there is a duplication in terms of fund manager, but in our personal belief, both these schemes have some intersection of about 60% of the stock, but they still have uniqueness enough to create a meritorious case to have both of them in the portfolio.
How should he divide this amount into these 7 funds, Feroz? What should be the allocation like?
See, in my opinion, if you allocate equal amounts, is when you will get about 50% more than large cap, and about 20% in mid cap, and about 30% in small cap. Differing from the being contrary to the common belief that small caps have to be smaller proportion than mid cap. In our belief, for the next financial year, small caps have a potential to outperform even mid caps, because mid cap is a very small universe of 150 stocks. Small cap at least has a larger tail. And the valuations on the small cap side, given there is an underperformance about 12 to 14% over the last 1 year of small cap vis-a-vis Nifty, I think there's more value emerging in the small cap and in the large cap. Mid cap is something you can go underweight, and the equal proportions in all the schemes read out will mean the impact of what I'm trying to say, Kavit.
Yeah, this is the recommendation for you. Thank you so much for sending us your query, Feroz. As our show is live right now, a lot of viewers are sending live questions on WhatsApp as well. So we have Mr. S.P. Sivakumar from Madurai who wants to ask you a question on Tata Digital India Fund. Hello, Mr. Sivakumar. How are you doing, sir?
I'm fine, madam. I'm fine.
Thank you so much for sending us your query. The information that I've got, Tata Digital Fund, and you are investing 6,000 rupees since last 2 years.
Yes.
All right,
Yes,
and you want to know if you can hold for a longer term in this particular fund.
Yes.
And tentative, how many years are you looking at?
I've been investing for 10 years, another 10 years.
10 years. Apart from this, what is the portfolio allocation, sir, do you have?
I am having Mira as a tax saver,
Okay.
3,500 rupees every month.
Okay.
And the Tata Balance Advantage Fund,
Okay.
5,000 rupees. And
Okay.
Canara Ropico Small Cap.
All right. And specifically, you plan to hold on to these funds for a longer period of time?
Yes, certainly, madam.
All right. So, Feroz, Tata Digital Fund, that's the only fund he's concerned about.
Wonderful. I think, Shivakumar, sir, I'll definitely give you some advice. You're calling from my place of birth. So I'm really thrilled to give you an answer. Coming back to your precise question of what do you do with Tata Digital Fund, I personally think going into a sector fund for a person who's wanting to invest for 10 odd years is not a sensible thing to do, because data clearly points out that if you take a sectoral fund over long periods of time, the returns converge, but the risk you've taken to generate the same return is far higher than a diversified equity fund. So taking more risk to get the same return is not prudent mathematically. And of course, perception-wise, if you looked at digital as a sector, had done very well about a year back, and that's what has prompted so many portfolios getting some infusion of the digital stocks, especially post-COVID. But I think they have faltered over the last 1 year, and now they're at the trough. So don't exit Tata Digital currently. Just hang in there. I think the underperformance in the IT stocks is over. Largely, of course, the global crisis impacts that sector the most because that has a global linkage far more than other sectors. So, but be patient. I think the damage is done. Relative outperformance is likely over the next 1.5 years. So if you've gone through the pain, wait for the pleasure to come in. That's what I would suggest. Now, your Mirai fund, of course, Nilesh Surana was the CIO, is a great CIO, small Korean fund, which started in some years or a decade and a half back, has done beautifully for Indian investors. So I would definitely vouch for it. And Canara Robeco also is a fund which is headed by Sri Datta, who's the best CIO I know from a small AMC standpoint. So both those schemes are good. Tata Digital, wait it out unless underperformance disappears, then you get out of it. And it's too late to get out at this point in time.
All right. Is there anything else that you want to ask Feroz?
Tata Balance Advantage Fund that I have mentioned.
Tata Balanced or Aditya Birla?
No, Tata Balance Advantage Fund. That's something I am holding.
Feroz?
Mr. Shivakumar, in our personal belief, keeping debt and equity separate is a brilliant idea. Again, mathematically established hypothesis. So any balanced fund is not needed. The reasons being as follows. Of course, there is an advantage of taxation on the debt side as well, but the costs are high on the debt side, which I don't think you need to be paying, especially for long periods of time. In debt, the fund manager has far lesser work than in equity. So I would choose a low-cost debt as my alternative in the form of an IDFC Gilt IBX index fund, which only invests in Government of India central government paper of 2027, low cost, no credit risk, no interest risk if held till maturity. That will be my debt strategy. So I will never combine both equity and debt in one fund, unless I had just 1,000 rupees and I didn't want to have the logistical nightmare of buying two separate funds.
All right. Thank you, Mr. Sivakumar, for sending us your query today. And we move on. Feroz, Mr. R. Jagannathan wants to ask you that in the new income tax regime, while there are no deductions, is there place for long-term capital gains to be taxed at the same rate as in the other tax regime, that is 10% for equity, 20% for debt funds, etc., or will this income be taxed at slab rates? Also, will it exempt income like interest on tax-free bonds remain exempted, or will this be taxed fully?
No, the new tax regime largely addresses incomes from salary and professional income. See, what happens is income tax has 5 heads of income. Capital gain is a separate head. That does not get impacted by which regime you chose. To answer your pointed question, you continue to pay taxes at the rate of 10% long term for equity. You get indexation benefit after 3 years in debt schemes. All that continues because the head of taxation is capital gain and not income from salary. And business and profession is another head. Gain on house property is the last but one, and from other sources there are 5 separate heads. So be very clear that capital gain does not get altered between new regime and the old regime. Only if you are in the highest tax bracket, which is 5 crore plus in the new regime, your surcharge limits are lower, especially now that the surcharge limits are capped at 15%, both on the debt side and the equity side. Even a 5 crore plus income also doesn't get impacted by this choice.
All right, Feroz, now since we are talking about tax saving and 31st March is around the corner, time for investors and taxpayers to analyze whether they want to go to the new tax regime or old tax regime. How would you, the thumb rule, what do you recommend?
See, Kavita, I would say it's a very inward-looking answer. If you're a very self-disciplined person and don't get lured by any of these offers you get to spend your savings, then the new tax regime leaves you in the driver's seat. You are allowed to take decisions on the merit of the individual product, which is the right way money needs to be managed. In the old tax regime, you are compelled to invest in certain schemes to get the tax break. So if I am a self-disciplined, very meticulous planner, and I want to do personal finance not by doing backseat driving, then the new tax regime is beautiful because it leaves you money in the hands. As long as you're not going to blow it up over weekends, the new tax regime leaves you more money and leaves you more space to plan as per your asset allocation and your plans rather than forced saving in asset classes which have lock-ins. So if you're not self-disciplined and you get carried away, you want external catalyst for discipline, then definitely the old regime has a lot to offer.
With that, thank you so much, Feroz, for being on the show and helping our viewers with that. Before signing off, I will leave you with our WhatsApp number and our email ID where we keep waiting for your questions, and we get these questions answered by our experts live. Thank you so much for watching. Goodbye.